Hello, everyone. It's December 4th, the last month of the year before we go into 2023. And I'm going to do a S&P 500 market update and then talk about the current positions that I'm in going into Monday and Tuesday, Wednesday, Thursday, and Friday. All right, so you can see on my screen we have the S&P continuous contracts and double bottom here, higher low, and then an attempt to get above that 200-day moving average. So this is actually a significant move because technically when the S&P gets above the 200-day moving average and stays above it, we're back in the bull market. So if you step back and you take a look at what has developed from the bottom here is that it's consolidated and into the midterms, and then we're getting that Christmas rally along with tax loss selling into the end of December, and then we've got a January effect, which is most likely going to provide additional momentum for stocks to run up higher and actually at least get up to 4,327, which would be the double top from the previous top attempt of the 200-day moving average break. There were a couple of attempts that the S&P did break through the 200-day moving average, trying to hold above that, but the bear market was a little too strong. When we get those bear market rallies, it looks like the S&P was attempting to stay in a bull market, but then it failed, and ultimately it just failed and made a 52-week low on the day of the midterms, the month of the midterms. So it looks like we're rallying higher, and we've got pretty strong candlestick confirmation, right, where big buyers stepped in since September. And now we're back above the 200-day moving average after consolidating for quite some time. And when you look at some of the indicators that I watch, the Squeeze Pro, the MACD, and the Slow Stochastic, you can't really determine too much from the Squeeze Pro and the MACD other than the momentum is above zero, which is positive. However, the Stochastic in this case is actually what they say is locked in above the 80% threshold, which is technically what they teach you is that that's overbought. But in overbought conditions, especially when the slow stochastic is locked in the way that it is right now, where the slow stochastic is above the 80 and flatlining, that implies that the market is more likely to stay overbought for quite some time before it pulls back and all these technical indicators on the slow stochastic start moving back toward the 20 and even down to the 10. Okay, and if it does, and price of the S&P remains above the 200-day moving average, then that would indicate more consolidation for the next leg up. Okay, so if I use the Fibonacci extension, obviously you can see there's a low here. There's also an SPX gap. Okay, and like I said before, like the slow stochastic is going to stay overbought for quite some time, and you can kind of see that there's this playing field where you got a gap in the SPX above and below, and the SPX is just a proxy of the S&P futures. You want to have you want to use the S&P futures more often as instead of using the SPX, because the S&P futures is traded by the whole entire world 24/7, whereas the SPX is only open during the cash session when the U.S. equities are open. So if you want to get a better representation of what the S&P is doing, you want to look at the S&P futures first, and then move down to the S&P SPX, and then go down to the S&P, the SPY ETF, which is which is a lot more, which has a lot more noise, far more gaps than the cash and then the futures. So here clearly on the SPX, you can see these gaps appear instantaneously, and then in the S&P futures, there's actually, I think there's a gap right there, okay? And futures gaps are very rare, okay? We had one at 4,035. That got filled right here on Jay Powell's speech, and we got another one here, okay, at 4,223. So I'm because the slow stochastic on the daily is locked and it's going to stay overbought, there's going to be more momentum, which is going to be coming from the short positions that are closing, because I think they're realizing that the momentum is not favoring the bears but favoring the bulls, and that momentum will be driven even higher as more people start to realize and close their short positions. And then until it gets up to 4,228, okay, then I don't think that SPX gap, which I showed here from the PPI or the CPI, that's not going to get filled until that gap at the 4,200. Now the SPX has a whole bunch of gaps above and below, right? And like I said before, the SPX is just, it has a little bit more noise, so you want to use the SPX S&P futures as your to represent what you actually, your decision making will be derived from the S&P futures. And then strategy wise, you want to see, okay, here I'll look at the SPX and SPY and see how many other gaps there are while the S&P futures is in an overbought, locked and overbought condition until that 4,200 ish gap gets filled. I don't think we're moving any lower, okay, especially in a seasonally strong month of December with Christmas rally, and then January effect with earnings. Okay, and then like the NASDAQ is going to just be doing the same things. And again, the NASDAQ has a futures gap at actually 2. So that's a really big, I mean, if you take a look at where we are right now to the second gap, that's a 12% move, 13% move, which could easily get there by the end of January, okay, or even the second week of January. That is, historically speaking, January effect. If you look it up on Google, January effect, out of any month, January is the most bullish. And if you do not understand that, it means that it's not all Januaries are bullish, but most of them, I would say 70% to 80%, especially after a massive sell-off that we had in 2022, this January is going to be quite bullish. So I wouldn't be surprised to see the NASDAQ up at 13,500 and even making a 52-week high by the end of January is possible. Anything is possible, but the probability is going to be in favor for the bulls. Okay, so my positions, I think historically speaking, all the beaten up stocks that are growth orientated, like Shopify and Roku, those things are going to run up like probably 50 to 60%. These growth stocks tend to do these massive run-ups into January and into actually probably follow through into February. So it's a good time to load up on shares of those companies if you haven't done so. But in terms of options, I have Tesla. Okay, and Tesla has, you can see Tesla has that gap there at 171. So I mean, if this was September, where September is historically very bearish, we would be looking to kind of strategically get into a position that's going to capture this gap fill. But technically speaking, even using the simplest technical approach here, where you just stay in the position as long as the price is trading above that green dot, which represents the 60 moving average, what you would just do is you just continue holding, and then because it has this rounding bottom, inverted head and shoulders type of look, inverted head and shoulders type of look, we actually have a move up to this 217. Okay, that's the 50-day moving average, Moreover, if you actually look at, because the assumption here is we're going to assume that these gaps below at 170 and 140, they're not going to get filled in the month of December. That's our main assumption. And our assumption is supported by the price trading above the 6-day moving average. On Friday, it was like really brutal in terms of the decay and the price action with literally zero momentum for about 5 hours. But then at the last hour of the day, bulls took control into a TGIF, and price remained above the 6-day moving average. I was actually hoping for like a doji, but green or a doji, it doesn't matter. As long as it's trading above the 6-day moving average, then the target here is around 214. Now, if I lower the time frame down to 3 minutes, you'll actually be able to see that there's actually a gap. There's a gap obviously here at 260, but that's, when is Tesla ever going to make like a 35% move in one day? Let's be realistic and find that next gap. So the next gap here is at 210. So if the market is bullish and we have the bulls take control on Monday and Tuesday, and then knowing that Tesla makes an average move of 4.5%, there's actually about 8% move that we can try to profit on from Monday and Tuesday. Now, I think if we get a big move on Monday, I mean, there is a 7-8 minute TTM squeeze that is looking very sharp here. Okay, it's that was the negative momentum, and now it's reversed into going to positive. And then if we kind of plot the toss option algorithm here, overlaying the chart here, you can see there's like these Darvish channels that are showing a yellow and purple, but ultimately if you average those Darvish channels out, it's just one large Darvish channel that's creating this. If you take this here and then the lower wick of here and extend it out, it's been trading within a range here. Okay, Tesla's been trading within a range, and we're waiting for that breakout because of that TTM squeeze showing us a breakout potential. And you can see there's that 215 50-day moving average as a major moving average target. Okay, and that would be a 10% move. Now, a 10% move in Tesla's, it happens. Okay, but if it's going to happen, I would say we would want to pay attention to the news, if any, comes out on Monday or Tuesday. Okay, because if it comes out on Monday, then this thing is going to shoot up to 217. There's a short squeeze, breakout at 200. Tesla, as you can see on this chart, it's been chopping around 194, right? Trying to break above 200. There's that Darvish channel 198. If price happens to move through that 198, we're likely to see the probability of an 8 to 10% move increases significantly. Okay, and we'll probably see that later at around 4 a.m. when the pre-market line's all set. Okay, so that's Tesla. So 210 is, there's a gap here at 210. If you lower your time frame to the 5 minute, so that's probably a really good level to hold your positions for from Monday and Tuesday. And I don't know, another $4 would be great, but the if this thing reverses on you for whatever reason, then you're going to give up a lot of those profits. So just manage your profits. I think it's not a bad idea to hold as long as you can until that gap fills. Reminds me of the Netflix. That Netflix was like 10x, 15x, and I knew there was a gap, and this Tesla is showing the same pattern. All right, the next position I have, I think the whole market is going to run up, but my other position that I have is basically Roku. Roku is just like, it has this bearish wolf wave, but it doesn't look bearish, right? Because it's still trading above these intraday moving averages. And then on the daily, actually not only on the daily, but I think there's like you can see on the weekly time frame, it's been in a very bearish market, and if this happens to squeeze and change the weekly candle from red to green, that's going to be a pretty significant move. I would say about, I mean, on the daily, if that's the like that, the 50-day moving average and all the slower moving averages are just overlaying each other, and all I can see is the next moving average is the 100, which would be a 10% move that takes it up to 65. So I got the $60 calls, and if it gets to 65, then I think those contracts are going to move from like 80 cents to all the way to $3. That's where I'll close it. Now the question is this going to run up and break out to, you know, the 200-day moving average, like a $20 move? Like, yeah, I don't think so. I think we just TGIF this into Tuesday. It could run, right, such that it overshoots the 100-day moving average. Then you would have to, I mean, I haven't looked at it yet in detail, but I mean, that's the next moving average with the Bollinger Bands contracting. Once it starts to expand out to 65, then I guess the next Darvas channel here would be the target at 68, and then another one at 75. But I'm sure there's a gap in here. I just don't want to spend my whole entire day looking for those gaps. Although those gaps, if you do find them, they are very, very profitable. Okay, so my thinking here on the Roku is just to hold them for the entire Monday. And if it gets to $65 sooner than Tuesday, before Tuesday, if it happens to reach $65 or $64 on Monday, then I'm definitely going to close off. Like if I had, for example, 10 contracts, I'm going to close off 8. All right, and then hold on to those 2 to see as runners, and then monitor those positions into Tuesday. Okay, so I hope that helps with what I see in the market. Netflix is also a pretty big one here. You can see there's a bearish wolf wave, but it's not acting like a bearish trade, and this would be a contrarian trade because we're in a very seasonally strong month. I think this thing runs up to the psychological target of 400. Lots of gaps to fill here into earnings, and if I could just find another one of those 7-8-minute TTM squeezes forming, which it is, because last time it formed here, that was a massive 15% move. It's forming again. I think Tuesday, by the end of close on Monday, I might take a position on that because I don't know if Netflix is going to break out on Monday. It does look like it's going to try to break out on Monday to 330. So I would like to get into this position somehow if it pulls back to 300 to retest that 6-day moving average. It's going to retest it. And I think if it's going to retest it, it's going to retest it on Wednesday into Thursday, right? Because Wednesdays are generally one of the worst trading days for options. Okay, thank you very much and have a great day.